Top three things in today's notebook. Number one, volatility, front month VIX. Number two, U.S. equity market volume. And number three, Europe, all of it. So first on the front month, and again, I'd probably call this front month frustration, the VIX being just pulverized and powdered for the year to date. You'll see nowhere in Hedgeye research to be long or short the VIX for the year to date because obviously a lot of people are trying to use these types of instruments to express the same position. So again, no appetite for that, but I will remind you that when the VIX hit this level, it hit this level both in August of last year and then again in January of this year. You had significant declines specifically in growth stocks after it hit this level. So this isn't the spot where you buy stocks, particularly growth stocks. In the August one, which was a bull market last year with growth accelerating, you still had a 3.5% decline in about 9 days. So again, watch out for that. That would be signal number one. Signal number two would be volume. There is none. Again, so again, what we care about is the volume on the up days of price versus the down days of price. So yesterday was an up day in price, and the volume was down 9% on a 1 month basis, and it was down 31% on a 3 month basis. So again, I don't care about the last 5 years. I care about day over day, week over week, month over month, and the up days versus the down days. On the down days, you get the volume. On the up days, you have no conviction. All you have is a bunch of hedge fund guys that are underperforming covering the spoos. So we'll leave it at that. Finally, Europe, again, continues to make a series of lower highs. We have been bullish on Europe for quite some time, but the rate of change, and again, that's how we roll, the rate of change in European economic growth data, particularly the PMIs this morning, is rolling over. So again, that is running really in coordinated fashion with the stock market. So if you look at France, for example, the PMI number dropped below 50 after being, I believe, 51.2 last month. So again, great to good to potentially bad. That's the European risk. And you are in May, and people are selling in May. So you look at an index like Italy, for example, people are saying, oh, it's down the other day because of going ex-dividend. No. That's what people who are long it say. If you got out of it, you'd say what happened, which is Italy's basically lost half of its gains. It's leading losers this morning after leading gainers for the first 4 months of the year, because again, people are starting to look at the cyclicality that is the slope of the line in European growth. So watch out for that. That's another reason why you'd be taking down European equity exposure into the doldrums of a European summer. So those are your top three things.